there is a narrative out there that Bitcoin has been stealing the inflows from gold, and that's just absurd. Bitcoin probably got 200 billion of appreciation in their market cap, and gold lost about $2 trillion.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel or you haven't already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support, and thank you for it. Tavi Costa is our guest today. Tavi is a global macro analyst at Crescat Capital, an asset management company that capitalizes on the most compelling macro themes to grow and protect wealth. His research has been frequently featured in financial publications such as Bloomberg and the Wall Street Journal. We're delighted to have Tavi once again as a return guest. It's time to saddle up and silver up for Tavi Costa. Tavi, welcome back to SBTV. How are you doing?
Patrick, thanks for having me again. I'm looking forward to this conversation.
Glad you had time for us. You are one very active guy on Twitter with the best charts out there, easily. History rhymes, and a number of guests on our show have said that history does not exactly repeat, but it often rhymes. And this was also the first line in Crescat's Q3 quarterly newsletter. And I do encourage our viewers to go ahead and read it for themselves. There's a lot of great info in there, great info that you and Kevin put out. And before we get into how history rhymes, though, Tavi, I want to ask you, is the Federal Reserve the main culprit responsible for fanning disproportionate booms and busts in the last century since its inception back in 1913?
Yeah, that's a broad question, but my answer is yes. I think that we have today what I call the great disconnect in the macro environment is absurdly detached from the risky assets valuations. I think that the financial markets as a whole has never been so dependent on monetary and fiscal stimulus. So certainly as a result of that, we now have this highly speculative environment. And that is supposedly to be somewhat justifiable by low rates, which I think it's a total fallacy. Valuations, when you look, especially medium terms, there's a lot of investors looking at valuations in terms of the market weighted indicators. But in medium terms, relative to interest rates, the residuals, if you plot the two, you can figure out that it's the highest imbalance that we've seen throughout history. And bonds are no different. You see that not only in the equity markets, the corporate bond market. I just had a chart yesterday looking at bonds yields here in the US relative to corporate bond yields relative to break even or inflation expectation. And for the first time in history, that turned negative. So what is the alternative for investors looking for growth, looking for protection, and looking for investments that actually yield something? There isn't. And I think that's what creates an environment for gold, precious metals, and miners that are likely to become the new growth stocks here in the following years. If you look at the indicators macro-wise, almost everything has somewhat rebounded since the pandemic lows, but the fiscal stimulus or the fiscal deficit has just deteriorated again. It hasn't improved at all. So it took us about $4 trillion of debt just to get us back to the worst levels of the global financial crisis. So debt monetization seems inevitable here for us. And when you look at the US banks, they're now lending more to the government than to corporations and households. I mean, that happened before, but not to the degree that we're seeing today. So it creates, in my view, an environment that we call a global synchronized debasement place where we're seeing global fiat currencies in general, I guess, devalue against gold and silver, even though we're seeing somewhat of a decline recently, where I think it's a great window for investment.
Yeah, we'll touch on a bunch of those things in a bit. But the Fed has a dual mandate, maximum employment, price stability. What should the Fed be doing to make the financial system a bit safer? Because everything you laid out there, it reeks of bubbles and landmines.
Yeah. Well, it has two mandates nowadays, in my view, which is different than what they claim to be. One of them is to suppress interest rates, given the level of long-term imbalances we have in terms of the debt problems. And the second one is to keep the equity markets, calm, even though we have record valuations. So this comes at a cost, and the cost is that assets that serve as an alternative for the monetary system should benefit from this. It's a supercharged environment where you have monetary dilution at the same time as you have the suppression of interest rates and even suppression of volatility. When you look today at global M2, it's at about $94 trillion. $94 trillion. It's growing at a 17% pace on a year-over-year basis. If you just use the rule of 72, money supply will probably double in 4 years. US public debt, for just as an example, is no different. It's at the same spot, growing at about 18, close to 20% year over year. So it's making hard assets begin to move to the upside, and that will have impacts in all other things. Regardless of gold and silver, we have copper now also at a 7-year high. Agricultural commodities are now moving as well. They're breaking out recently, up about 10% year over year, which is, I think it's a 3-year high or a 4-year high. It's pretty significant in terms of the delta. So it's difficult not to see an inflationary narrative emerging here pretty soon. But it's probably the degree of fiscal and monetary stimulus in conjunction that will be the creation of that. And I'm worried about that, because I think that valuations wouldn't be justified if we have an inflationary environment. So I think we're playing with fire in some of the risky assets that we're seeing a lot of the large pension funds invested in today. Our goal here is to look for those alternatives, and I can only think of that one that has the liquidity, enough liquidity to afford this type of inflows would have to be gold. But that will have an impact in all sorts of other assets, even Bitcoin being one, or silver, or miners. So there's a lot of opportunities. It's not only a very negative scenario. I think there's a lot of good opportunities that will come out from what we're seeing.
Okay. And you in that Q3 2020 quarterly investor report that Crescat provided, you did call, or the US stock market was called, the most euphorically overvalued in history. And you gave a lot of reasons why. But within those reasons, what are maybe the one or two things that really concern you the most?
Well, there are two. I think the faith that central banks have the markets back. I've been talking about this for some time now, and I think a lot of people have been ignoring that, and the markets have been ignoring that. I mean, we're at all-time highs. I think that's one important one, and the low interest rate fallacy, where everyone thinks it justifies the valuations that we have. It does to a certain degree, but that's just one of the variables when you're calculating the present value of an asset. There's also the fundamental growth of that asset, where in a depressed environment of macro indicators, it's pretty hard to see the economy growing and seeing organic economic growth revamping here anytime soon. It's important to go back to 2019 and 2018, where growth wasn't, economic activity wasn't booming. We had prices of risky assets booming like we have today back then. But before the pandemic, and that's a result of the imbalances that we have in the system, and that don't allow markets or corporations to grow fundamentally as they used to in other decades. So we're reaching an exhaustion point as well in terms of risk parity strategies, right? We look at especially equity markets and bond markets being record overvalued. Where are those risk parity strategies going to be investing in? That's what they're due as part of their mandates. So I think that's part of the reason why we have those valuations issues that we have today. But there are problems all over, from price to book to free cash flow multiples to sales multiples to indebtedness in corporations, yields of how they're actually being able to borrow money at record cheap levels, even though corporations are record leveraged. So, a lot of things don't make sense. And I think it creates another dependency for central banks, especially the Federal Reserve, to continue to hold the hands of those pockets of the market. And so monetary dilution should continue to be severe going forward, given that environment. Again, there, I don't want to sound so negative, but there's a lot of opportunities here. And we had a window recently where the gold to S&P 500 ratio, which I've been calling for a rise in that ratio, and it's been rising in the last years. But in the last month, it had a 15% decline, which was the largest decline in 37 years. I think that's an opportunity. That's enough because the macro reasons for you to own that ratio, in other words, buy gold and sell stocks, have not changed. The valuations on both sides are extreme. You have gold extremely cheap and equity markets extremely expensive. So that ratio for me makes sense. As we've seen throughout history, it's a ratio that tends to work, especially when you have this record imbalance as well in the commodities space. The commodities have never been so cheap relative to equity markets, even though gold has been reaching near all-time highs. Again, I think that gold and silver and miners are looking extremely good as an investment going forward, given this lack of alternatives of assets and lack of yield and negative bond environment, negative yielding bond environment, and so it's been I guess a part of the market's been so much out of favor. Anyways, I see a lot of issues in the equity markets in the U.S. given the valuations, and I can't stress enough how important it is for investors to look a little beyond that, outside of especially the tech sector. The tech sector is just such a speculative market today, where all you need is a software business where you deserve now a valuation of 50, 60 times sales. That for me makes absolutely no sense. I really think that miners will replace a lot of those positions going forward for other portfolios too.
Okay, well, we'll touch on the gold price and things in a bit. But you also have a chart which overlaid the Dow Jones Industrial Average between 1919 and 1932, and the same average between 2009 and 2020, and it's a remarkable correlation between the two. Given that the chart showed a drastic decline during the 1919 to 1932 period in the Dow towards the end of the chart, the right-hand side of the chart, are you expecting a substantial decline in the Dow to happen at any moment henceforth?
Well, that's a good question, because usually you don't see a soft landing of those record valuations that we have today. And arguably we have the worst valuations, at least in our models, looking at 15 factors that we align. 11 of those 15 are all-time highs. 3 of them basically at 97th percentile, and one of them is at 91st percentile. So it's pretty close, all of them at all-time highs. And when you look at all the way back to the 1900s, you can see clearly that never happened in the past. Looking at median valuations relative to even market cap valuation, market cap weighted valuations. Everything looks pretty frothy. So how do you unwind those things? First, well, it creates those narratives that and some of those pockets of the markets are too big to fail, which I don't believe. And we hear that, we heard that in 08, we heard that in 2000. I'm sure that we heard that also in 1929. I wasn't alive to hear those narratives, but I'm sure we heard something related to those. And usually it's, markets work as a pendulum. And when you see a decline in valuations, they usually tend to surpass the median valuations. We're probably 60% off the median valuation historically. So, if we do see a decline, you would expect that be a collapse in equity markets, but you need a trigger, and it has to be a liquidity trigger. In my view, a liquidity trigger is usually caused by or an inflationary environment, a deflationary environment, or in some sort of outflows of assets caused perhaps of what I call the risk parity exhaustion point. So I think there are reasons to think that way. And unfortunately, a lot of people are betting on this faith on central banks going forward. Where I think that there is enough reasons to believe that we could have a very highly inflationary environment going forward, especially because of how hard assets have been behaving. Hard assets have been was the biggest reason why we haven't seen inflation so far, and they have been rising recently. And I think that can change the macro environment quite a lot, along with the fiscal and monetary stimulus. So, anyways, it's a lot to unpack here, but there are a lot of relations to other prior peaks in the market, even if it is in the 1970s, or we have given this belief of central banks and this inflection point of a change, I guess, in the way the monetary environment has been working. Back then was the break of the gold standard. Today is unlimited QE. It's pretty similar, just as impactful. And 1929 was more of a deflationary environment. All of those, equity markets suffer significantly. I think we have a similar position today, and unfortunately, given that and the excessive bullishness we see all over, and also positioning too of very small amount of investors actually shorting the market as well. It's a little bit scary. Anyways, I just don't see the value of investing in equity markets today. It's very hard to find a company that yields more than inflation expectation. I'm talking about yielding on the earnings basis or the dividend yield basis. So it's been pretty difficult to find good investments in the markets. And I think more and more market participants will be looking for other things that would probably be hard assets, especially the ones that are more rare. And that would be that bucket would be gold and silver.
In a globalized, synchronized debasement of currencies, which we're kind of sort of seeing, has your research brought you into the area of just how high you might see real inflation go, how high it could get to, and its impact on the asset prices?
Well, that's certainly, when people ask me, well, what do you think about what's your outlook for inflation or deflation going forward? I think that answer should be a lot more important and a lot more relevant to the equity market investors that are long today this market, and that's because of the valuations would make no sense given if inflation starts to pick up, and we're seeing that in the break evens right now. As I said, commodity markets tends to lead that sort of direction, and copper prices being at a 7-year high. Those are all important signs that on top of the capacity, industrial capacity of the U.S. being very low, that could cause supply shocks as well. So there are a lot of issues, and indebtedness in the world tends to cause supply disruption, even in commodity markets, as we've seen in the 70s and early 90s with the geopolitical issues that I'm referring to in the Middle East and so forth, that cause oil prices to spike. So I think there's a lot of reasons to be concerned about those issues. Those are all potential things that could happen and cause inflation to rise. I don't know exactly. I don't think we're going to see a hyperinflationary environment, because those tend to happen in more issues where we have, especially in political leadership. That tends to happen mostly in emerging markets, and I don't think the U.S. is as bad as those places. Can we see that in Argentina? We're already seeing it, but in Brazil, those are more possible scenarios. But I'm not sure if we're going to see hyperinflation. And I don't need to call for that and position for that necessarily, but I do think it's possible to see inflation, moderate to high inflation going forward, which would be very difficult to justify the multiples we have in equity markets today. Even with break even where it is right now, approaching 2% on the 10-year, how do you justify some of those 50, 60 times sales businesses out there? Are they going to grow to the level where the market expectation really is hoping for? I think there's a lot of questions in some of the businesses out there. Again, and it goes back to that. A lot of those in the software businesses. I think there's two buckets of the market that look a little troublesome. One of those is in those high flying tech names, and the second one is the heavy balance sheet names that could struggle going forward with the cost of capital rising and perhaps becoming a problem for some of those businesses.
So you touched on this: buy gold, sell stocks. It's been Crescat's theme for some time, and the correction in the gold price recently has been a little bit steeper than, than the March correction. What's your opinion on where the gold price is headed to short term?
So we had about, when you look back to the last bull market in gold, and arguably went from 2001 to 2011. And from those, you had about six times where gold actually had a sell off of over 10%. That's very normal. We had a 14% this time. And there were plenty 12 to 14% sell offs back in that period, including one, as you remember. And some people like to say that that was a break of the bull market, and we started a new one in 2009. But 2008 was a 30% decline, and we resumed back to normal, business as normal in terms of the gold market. And the market from the very bottom of '01 all the way to 2011 was an increase, I believe, close to 700% or 650% of increase. And it's important to remember gold is a big market, and that takes other companies and other assets much higher, such as silver, that tends to benefit as a more volatile version of gold, I guess. I see, the bottoming process, market bottoming is a process. But there's a lot of signs that maybe we're reaching that level. We're starting to see the resilience in the silver market. Well, silver has been outperforming gold recently. We have especially silver miners outperforming gold miners. We have junior miners outperforming senior miners. Those are all good signs in the markets. We have real yields. Real yields is one of the most critical macro drivers for gold in the past. And when you look at that, it's been actually on an inverted basis. It's been, or I should say, real yields have been starting to turn lower again. I think it's mostly driven by the inflation expectation side of things, because nominal rates have also been rising, and certainly that is also a driver for gold. So there is also the other part of it. I mean, the other parts of it we have negative yielding bonds. When you look at the market cap of those sovereign bonds, it's at a new highs, right? At about 17 or so trillion dollars. That's a significant amount. And the lack of alternatives for investments outside of the gold market is becoming more and more extreme. As I pointed out, the corporate bonds yields now yielding less than inflation expectation. But gold is starting to outperform even the risk parity index. When you just look at risk parity indexes that are available, have been outperforming those since 2019. I think that trend is irreversible. So I think it's a very cheap relative to the monetary base. It's an asset that I think will replace a lot of the sovereign bond instruments in a significant way. And there's another issue, Patrick, that not a lot of people talk about, which is what's happening with the treasury market. Technically, there's going to be about $8.5 trillion of treasuries that will be maturing by the end of 2021. And who is going to be the buyer of all this? The government is not in a position where it can pay down its debt. It's going to have to roll that. So as it rolls, it's going to have to issue treasuries. Somebody's going to have to be the buyer. Well, guess what? The Federal Reserve can't wait to buy those. So that's just a second wave of Fed assets, perhaps increasing significantly going forward. It creates another demand for gold. And it's important to remember that this is probably the largest supply-demand mismatch in gold markets that we've seen throughout history. The demand side is pretty clear that I've laid out here, but the supply side is even worse. I mean, we're not seeing investments in the industry. Exploration budget has been declining trend for the last decade. New discoveries. We haven't seen new discoveries in the gold market, significant discoveries over 2 million ounces worldwide in the last 3 years. So there's a lot of issues there as well. The large miners are if you look at the capex cycle for the whole industry, has been declining and diverging from gold prices, which is also very positive for gold. Those companies have been have issues with misallocating capital, and now it's been changing. They have to become more conservative. Given this reputation of being such a capital destroyers for so long. I think this is all opportunity. I think that this is maybe overdue. That miners will start becoming profitable businesses and will actually become good businesses to invest. So, and the market is not ready for that yet. I think there's a lot of people that are very reluctant to spend to invest in this space. And pretty clearly, what you're talking about, this decline of 14% in the gold market. Look, we're invested. We're pretty heavily invested in the space, especially in the exploration side of the industry. And capital really dried up in the last few months. I mean, it's pretty interesting how the sentiment changed quickly. But again, go back to the bull market, the last bull market, those 6 times that the market sold off over 10% of the time. Those are great times to come in and buy it, and there will always be a new narrative that trying to tell you that this time will be different and then gold prices won't rise. And this time is probably the vaccine. Vaccine news will make the economy start growing again. Vaccine news are positive, but go back to 2019, the economy wasn't booming. There is still a need, endless need, in my view, for monetary and fiscal stimulus to continue to fund, somewhat of a growth and to try to calm down the equity markets and continue to fund this uprise in prices in risky assets. So that shouldn't change. That should continue, and I think will continue to support gold prices moving forward.
Yeah, given that gold and silver mining equities, since we're touching on these, are one of the most speculative and volatile sectors, how can investors navigate through this potential minefield?
There's a lot of ways. I think most investors like to look at the very large and famous names, the Kirklands and Newmonts and Barricks of the world. Even Warren Buffett touched a little bit on Barrick and sold again a little bit. But that seems to be where a lot of investors have been focusing on, and that's pretty interesting side of the industry where we have top 50 and top 20 miners growing free cash flow significantly. Last time I checked, the top 50 was growing at about 130% year over year free cash flow. There isn't any other industry growing that I can see fundamentally growing in this direction as the miners have been in it. This is truly unprecedented. It's not like the software industry that has been growing in the past, and it's no surprise for people. This is a surprise. When you look at the balance sheets of those miners, if they were a sector, that would be the cleanest balance sheet of the whole market. And again, it's asymmetry here that is interesting. I've posted this chart before, but the precious metals mining industry is worth about $600 billion, give it or take. And when you look at the Apple's market cap is about 3.5 times that. So one company, it's nothing against Apple. It's just one company, one single company is worth 3.5 times the whole industry, which I think is the only industry that truly benefits from this environment. So I think there's a lot of reasons to own precious metals today. And the mining space for me is one of the most opportunistic sides of the market. In our view, given, I think buying gold and buying silver and buying Bitcoin and buying the miners is not so much of a contrarian take. But if there's one part of the market that is pretty contrarian, in my view, is the exploration side of the industry, where a lot of people see as a very, very speculative. So at Crescat, we decided to partner with Quentin Henney. You probably know him. Used to be the CEO of Nova Resources, a chairman of Nova Resources still in Australia. And then it's probably one of the most intelligent exploration geologists we can find in the industry. And it's been a huge pleasure to work with him and find the most prolific deposits we can find in the world today. So we've been focusing all sorts of jurisdictions in Canada, US, Mexico, Bolivia, Peru, Brazil, Australia, and so forth. And I think that there's a lot of good opportunities. Our goal is to see that discovery curve that I was referring to begin to pick up again. And if that happens, we want to be part of the companies that are actually participating on that pickup of that curve. So I think I think we have at least 40 to 50 names in our portfolio right now. And I think at least 10 of those can be very, very large discoveries in the gold space in the following years. And that would be very attractive for the large miners. But again, it's an industry that requires a lot of knowledge and a lot of I think a lot of support from a staff to really understand and navigate the space.
Just got to get some clarity on this before we head out. If you could explain one more time the gold to risk parity index ratio and its significance.
Well, I think the significance of that is because the popularity of that strategy over the last decades. I think Ray Dalio was one of the people that really applied that idea in a big way, and it worked very well for many decades. But it's getting to an extreme, and that's what I call an exhaustion point. When you look at, regardless if it is government bonds, corporate bonds, or equity markets, the valuations have really, really reached a level that we've never seen before. So, how do you go from here? Do bonds really offer that protection that they used to in the past? And will they protect you in the future here? I think that's a bigger question for a lot of those institutions. And there will be, I think, outflows from those names, from those asset classes. And I think that there will be inflows in the gold market and other alternatives of the monetary system, which are silver and perhaps Bitcoin. There is a narrative out there that Bitcoin has been stealing the inflows from gold, and that's just absurd. Bitcoin probably got 200 billion or so of appreciation in their market cap, and gold lost about $2 trillion. So this decline in this appreciation in Bitcoin would probably explain about 10% of the decline in gold, and so it's not valid, that comparison in my view. But there's a reason to own all those assets, and I think in my view that's what a lot of the pension funds will start to see. I mean, pension funds, especially the large pillars of the economy, that there are large capital allocators, are extremely under allocated in precious metals. That used to be a major part of any portfolio back in the 70s and 80s. Now it's absolutely nothing. And it's hard to get one of those pension funds to get even 2-3% of their fund in gold. So I think there's a lot of room for improvement there, and that will lead to a large improvement also in the mining space, where I think there is a significant upside here for that industry for the following years. I think that if you are in very selective name, you could have avoided a lot of the drawdown that we had in the last 3 months. Our funds are up 90% since July, and we launched right at the peak of the gold market. So, I'm not saying we're going to replicate that performance going forward. I think that's up for a lot of work on our side, but it's just show that there's a lot of room for fundamental work and activism approach here to make things happen and make money in this industry, given this environment. More and more investors will be looking for those alternatives of the monetary system. I think that there's a fiduciary duty of us to really look for ways of protecting capital and growing capital, and this is, in my view, the only place where you can truly park your money and take advantage of this imbalances that we're seeing. They'll probably won't change in the following years.
Tavi, before we wrap up, can you let our listeners know more about Crescat Capital?
Yes, Crescat Capital is a global macro hedge fund that recently launched as well. We have our funds go back to a long time. A global macro strategy goes back to 2006 with the idea of capitalizing in the housing bust and large macro events. Since then, it's been doing really well. Long short goes back 2001. Also, great fund to invest in my view. Obviously, I'm biased, but we recently launched a precious metals fund that is because of our views, and that is fully invested in this exploration side of the industry today. And about 95% of the names we have is invested in this industry, and I think there's a lot of opportunity here. I think we're very excited about the growth in assets of the firm, and I think that will continue to pick up going forward. And we're excited to deploy that capital in an industry that we truly believe that will be the large benefiter of this environment. We are easy to find, and just type Crescat on Google, and you can see our website, crescat.net, where you can find a lot of our letters. There's a lot of letters, very in-depth letters with a lot of charts. and writings that we put together. I think those are great. And if you want to find me on Twitter at Tavi Costa, I post charts and ideas pretty much daily. And those are all involved with our views and the way we are actually positioned in the portfolio too.
Okay. Tavi Costa, we appreciate the time you've given us, and we wish you and the whole Crescat team a very Merry Christmas.
Thanks, Patrick. You as well.
That was Tavi Costa from Crescat Capital. For more of his insights on the global economy, please visit www.crescat.net. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. Do also check out the SBTV podcast on iTunes and Spotify.